This is John Jacobs, and joining me today will be Bib Strench. Welcome to the ETF BILD UIT QQQ UIT to open-end conversion webinar. We want to talk about what's going on with the Qs. Before we begin, I did want to have everyone just take a moment to think about that. This is 9/11, 24th anniversary, and I think it was a very, very challenging time for us in the U.S. in financial services, and I think it's appropriate that we never forget and that we always remember that and look back to that resilience that kind of pulled us together as we continue to face challenging times. That being said, so ETF BILD, the ETF BILD project was created by Bib, myself, Justin Mize, and Rich Carey, and our idea was, let's put together a group or a little project to float the issues that may not be addressed because of some of the concentration that occurs with the assets, the index providers, and others in the industry, so we can raise more interesting questions and spend time to do that. And that's what we're doing today. So today we have, obviously a very interesting conversation. What's near and dear to my heart is 26 years after launch QQQ, Invesco is looking to convert the QQQ from a unit investment trust to an open-end management company. So Bib, why don't we kick it over to you and tell us exactly what they're doing, and then we can have a conversation about it. And as always, there is a chat function. If you want to throw a question in there, please do. We're happy to take them all in. So.
Yeah, thanks, John. And, I'm also, besides ETF BILD, I'm a partner at Thompson, Hine, in their DC office. And I think John and I are kind of a unique duo here to talk about this topic. I mean, John will get into his history with the QQQ. I happen to be in the office of the Division of Investment Management when the first exemptive application came in to permit an ETF under the 40 Act, and that ETF was a unit investment trust. So, usually the legal side's not that important. I think today it is kind of important. So I think we both bring kind of unique approaches to this topic. I will say, and we'll talk about it, there's a proxy out there. So you need shareholder vote, at least PowerShares does, and QQQ to affect this transition. We are not involved in that process. So we're not soliciting votes. So this is kind of a disclaimer. That's separate, and we wish them all the luck in securing the vote. So I thought I would just set the table, because you keep hearing UIT, Unit Investment Trust. What is this entity, and really what is an open-end fund? Because you often hear mutual fund and ETF, and really the 40 Act itself does not refer to those. So what's interesting about the unit investment trust, and the structure is important, is that it is defined in the 1940 Act, and it's a fixed portfolio of securities. And it's governed by an indenture, so basically an agreement, and it's administered by a bank. So I think what's important about those qualities is it's very fixed in nature. There's not much ability to disturb that. And from one perspective, that's good for investors, because they know that there's rules in place on how the UIT, in this case the QQQ, is run, and that there's really safeguards kind of built in for that, to protect that fixed portfolio of securities. I mentioned a bank trustee. We'll talk about that when it goes, or if it goes, to open-end structure. There'll be a board with humans, not a bank. I think the other thing is that while it is a fixed portfolio, if you look at the definition under the 40 Act, There is what in the UIT world is called substitution. QQQ and others at the beginning got exempted relief to allow substitution, and in this case, to allow the UIT to be able to track, the Nasdaq 100. Real quick, and then I'll throw it back to John. So, that's what the QQQ is now. It's a UIT. An open-end fund, which is the vast majority of ETFs. As John mentioned, it's a management company. It's governed by mostly the same rules as a UIT, but it has much more flexibility in how it can operate. And since it is kind of the ETF of the structure of choice for ETFs, it's more modern. There's been more, obviously it's 6011, which was designed for that structure. It has more flexibility than the UIT, and it's more in line with a traditional mutual fund. And probably there's so many key differences, but one is that it has an external investment advisor that manages it. And the last thing I'll say throughout this whole conversation, we got to keep in mind this is an index fund. So index funds typically are not managed. So bottom line, both structures work for an index fund, and we'll get more into the pros and cons in a little bit.
Great, thank you. So a lot of questions I've asked a lot is, why did the Nasdaq pick the UIT format to begin with? Back as Bill pointed out, that was the historical one. The early ETFs were UITs. However, at the same time, we were launching Qs. The old BGI, which is now iShares, was launching their family, and they chose not to use a UIT. We had very special reasons to launch this in the format of a unit investment trust. And so to do this, let's go back in time a little bit. I'm going to use a couple of terms that probably are a little out of date for people, but I'm going to talk about the NASD, which is now FINRA, and I'll talk about the Amex, which is now part of the New York Stock Exchange. In October of 1998, NASD was owned Nasdaq, and in October of 1998, the NASD also bought the American Stock Exchange to create the market of markets. The idea was that we could offer equities on Nasdaq and ADRs and ETFs and options on the American Stock Exchange. So it was going to be, a market of markets. Didn't actually work out that way, but it had real strong implications for the Qs. So again, in October of 1998, the NASD now owns AMX and Nasdaq. Nasdaq and no other market, New York, Nasdaq, no one else listed these products, which weren't even called ETFs back then. Only the American Stock Exchange listed these products. They were the only market. So we knew early on that the QQQ was going to list on the American Stock Exchange. Secondly, Nasdaq is the owner of the Nasdaq 100 index. We determine the rules. We determine who's in and who's out based on our objective criteria, the rules-based index. Nasdaq was also the listing market of all the companies in the Nasdaq 100 index, right? So you can imagine that, from Apple and Qualcomm to everything in between. So Nasdaq was the listing market. And then lastly, Nasdaq owned Nasdaq AMX Investment Product Services, Inc., which is the organization we use to actually file and the sponsor of the UIT that became QQQ. That family, by the way, eventually added 4 builders ETFs. It added a UCITS compliant ETF called EQQQ in Europe. But that was the Nasdaq fund family within Nasdaq that eventually was transferred to PowerShares as they were being acquired by Invesco. So the reason that's important to understand is that, unlike S&P and Dow and MSCI and any other indexer you can name on the planet, we really have a different relationship with the constituents of the Nasdaq 100 versus other indexers on their flagship indexes. We have an individual relationship with every single issuer in the Nasdaq 100, and every single and therefore it's a little different for us, right? It makes, there are conversations we did not want to have with Nasdaq listed companies, such as why you're in the index and why you're not in the index, which means why you're in the product and why you're not in the product and the weight you're in the product and so on. We did not want to have conversations with Nasdaq companies on proxy issues. So when we looked around for a structure to launch this, the UIT, as Bib pointed out earlier, was an ideal solution. Not only was it a faster path to market, but it allowed us to put in a very clear, objective set of rules to govern everything about the Qs. So, for example, it's a rules-based index. Nasdaq only administers those rules. Investors determine who is in and who is out based on the market cap and trading volume of the constituents on Nasdaq, and they re-rank it every year and so on and so forth. As an index administrator, it's a rules-based, objective, transparent index. Secondly, we wanted the Bank of New York, who's the trustee here, to be able to just replicate the index. We wanted them to replicate the index in the exact 100 constituents in their exact order. It's a market cap weighted index. We did modify it. I'll get to that in a second at one point, and then took the modification off. But our goal was always to have the biggest stock have the heaviest weight and the smallest stock to have the lightest weight, and go down in order and replicate the index exactly. Third, our instructions were to the Bank of New York to, when proxy season came, they were to vote their proxies last if permitted, and they were to vote their proxy in line with the votes already cast in majority. What we wanted to do is make sure Nasdaq always, as Nasdaq Investment Product Services Inc., the Qs always voted the proxy, helped with the quorum, but never weighed in on issues of governance like that, because again, we felt we had a conflict with being the listed market and regulating these companies. So we regulated these companies and so on. So as you can imagine, our conversations were with companies. I want to be in the Nasdaq 100. We say, fine, that's then up to the investors. That's up to shareholders to determine whether you're in or out. How come I want my weight to be higher in the QQQ? That is up to exactly your weight in the index. Can you vote your proxy this way to help management in this battle with this so-and-so? And said, no, we cannot. We vote this way. Again, because we had a rules-based, transparent index and a rules-based, objective product structure, it made conversations between Nasdaq and Nasdaq listed companies very, very straightforward. And as I told the various CEOs at Nasdaq over the years, this is good news for you. You will never be in a position where you have to have subjectivity when it comes to putting companies in or out of the Nasdaq 100, because you make a company happy by putting one company in, you're going to make another company unhappy. And these companies have a choice of listing market. So long story short, that was why we chose the UIT. It satisfied our needs. We wanted to get to market. And if you remember back to the market conditions at that point in time, it was a great time to get to the market. We know that we were filling a need in the marketplace. Back then, and as is today, people say, how's the market doing? And they say, Nasdaq's up and Dow is flat and S&P is down, or something along those lines. And back then, you could hit the S&P, you could hit Dow, you could hit some other, but at Nasdaq, it was very difficult to actually invest or trade in the Nasdaq. So by bringing this product to market, we did so in a way that satisfied all the needs of all the different parties involved, filled this gap in the marketplace, and its success just took off from day one. So it did exactly what we wanted it to do, and more. We had no idea it was going to be as successful, like to say we did, but we had no idea it was going to be as successful as it was. So fast forwarding to today, it's time. It's got different ownership, and let me talk. You just mentioned two things. It is a market cap weighted index. In 1998, in the fall of 1998, the index became, no products on it yet, became nicknamed the Wintel Index, because at that point in time, Microsoft and Intel had a huge run up in price, and they threw off the risk diversification test, and they really put the index kind of out of whack. It was, if you invested in those two stocks, you really got the entire basket. So we invented, and there's still a patent on it that Nasdaq owns, um, to modify market cap weighted. But one of the things we did about this patent is we said, if we're going to do this, it means we're going to bring down the weights of all the bigger stocks and raise the rates of the smaller stocks, all on the 1% line. So our goal was to keep the stocks in the same order, in the same proportion to each other, to keep the flavor and the goal of the Nasdaq 100 index. Two of the stocks that in 1998 were doing not so well were Apple and Qualcomm. They actually got overweighted. So we put that modification in and then launched the product in the spring, in March of 1999, with the modified market cap weighted on the index. 13 years later, Apple and Qualcomm were a different story. Things had changed, and Apple still was overweighted in the index. Qualcomm was as well. And so at that point in time, it was clear that we should remove the modified market cap weighting, go back to a market cap weighted pure, which is where it is today. But the Nasdaq as an index provider has the ability to do that. And in the past, the index had to be RIC compliant because the product was just replicating the index. In the new structure, obviously, Invesco is going to have more flexibility to comply with the RIC diversification because they'll be able to do it at the product level. The other thing to note is that over time, it was becoming more and more difficult as Nasdaq, which is one of the largest exchange companies on the planet, owns dozens of exchanges around the world, lots of products and services to different constituencies. It was difficult for Nasdaq at times to own a fund company. So when I looked around, we decided that we were going to spin the Qs out, the Nasdaq Investment Product Services Inc. Subsidiary, the fund company out with the 6 ETFs that had in it. You know, we went through a rigorous process with all the ETF families out there and came up with a really beneficial transaction with friends at Power Shares as they were being acquired by Invesco. So, and that's how the Qs ended up as Invesco QQQ today. Bib, I think I'll stop there and turn it over to you so you can actually walk through what are the dates and exactly what are the proposals that they're looking to do. Then I can talk about the impact of the conversion.
Sure, John. And there is a vote, so there is a proxy. It's a lengthy proxy, and as expected, well written and reviewed by the SEC, and it covers many of the topics John just talked about without the color and the lore and kind of filling in. So that's really helpful, John. So a shareholder meeting has been called for October 24th, 2025. To have any shareholder meeting, you need a quorum. We'll mention this in a second. It's never easy to get people to vote. So we'll see if that date they actually have that meeting then, or they have to adjourn it. There's 3 proposals, and they're very important proposals, and we'll touch on them a little bit later. But I mentioned that a UIT is governed by a trusted indenture, and it's a set of rules. You know, it's much like an index has a set of rules, and that is going to have to be modified to accommodate the open-end fund structure and to provide the flexibility that John is talking about. So that's proposal 1. The second, I mentioned the introduction of humans in place of the Bank of New York. So it's going to have a board of trustees, and the shareholders or unit holders are being asked to vote and approve them. And we'll get into governance in a little bit. And then the third proposal is that, you know, technically the entity that creates a UIT, which is called a sponsor, you know, John mentioned the structure and how it worked at Nasdaq, but they by law have a lot more limited role, and under the third proposal, it's an investment advisory agreement with PowerShares. And so they will manage the product, even though it's an index fund. And we'll talk about this in a second. That gives them much more flexibility on how QQQ will operate. So real quick, the process is that each one of these proposals, for whatever reasons, have different vote thresholds. I mentioned the challenge of getting the vote. So it'll be interesting to see how that plays out. Because it's been a real problem in the entire, especially the ETF industry, trying to get any kind of vote, whether it's going to be a new trustee, is always a really tough process. There are concepts, broker non-votes, where you lose a big chunk of the votes that you're hoping to get to pass these measures. You lose them out of the starting gate. With the QQQ, and John could talk about this more, its shareholder base is very interesting. Obviously, a lot of institutional investors. There's many are not interested in voting proxies or helping somebody get to quorum. And then I think another one that's kind of interesting is that you have to have a record date. So you have to have a fixed number of shareholders eligible to vote. And a product like the QQQ, investors are coming in and coming out, and you may be losing people or having a difficult argument to get them to vote because they've already sold their QQQ shares. So good luck to PowerShares. These things always happen, but well, not always, but most of the times they happen. And it will be kind of a tough road. So why don't I flip it back to you, John? And
sure, I think that's a great summary. The other point about that, I think, is to understand it costs money to do these kind of proxies. It's a process, and it does require a financial impact. So one of the things that I'm also been asked over the years is, well, why didn't Nasdaq convert it to an open-end company? And again, going back to the history, while we owned the product when it first came out, and for the first years, and still to this day, there's a huge retail component. Early on, there was no institutional investment in the Qs. The Qs were actually, like many people have commented, was the first ETF to really hit the retail screens. I mean, Spider's been around since '93, but 99 with the huge run up in tech stocks and all the IPOs that were going on, and the first massive wave of individual investors and traders coming into the marketplace, et cetera. The Qs really was a retail product early on, and it's grown in time to be such an institutional product that it is today. So it's both retail and institutional. Therefore, there is a challenge. And back then we looked at it and we said it was just impossible to figure out how we were going to pull off a vote like that. And then we decided that even if we pulled it off, it's still going to be the perceived conflict of Nasdaq owning a fund family, being a buy-side firm at the same time that we are primarily doing services for listed companies and the sell side. So anyway, so let's talk about. So I think that so I'm asked, why Invesco? Why now? And I think that Invesco is in a different place, and I think they have an absolutely great opportunity, because Invesco, as large and diversified and complex firm that they are, have lots and lots of very deep relationships across the street. Therefore, I am confident, I haven't spoken to anybody in Invesco about this, but I'm very confident that they have a really great pipeline into a lot of the major institutional investors in the Qs, and that will be conversations that they have. So they have relationships, which will follow up with conversations. So to Bib's point, it's not what they normally do. Institutions don't care about voting. That's a different. So I think that you'll see that the Invesco team is very proactive in talking to the institutional side. They've also hired Sodali and Company to do the shareholder outreach for retail investors and other investors. This is a firm that's got very experienced. This is what they do and how they do it, and they're just very focused on this effort. So between the two of them, I think that QQQ, the Invesco team, is doing everything in its power in order to make this happen. I think I agree with Bibb. The big challenge is that there is a lot of turnover in the product, and setting a record date and then 3 months later a vote is going to be a challenge. Or 2 months later, it's going to be a challenge. But I certainly think they're up for it. So the next thing I did want to mention is, what does it actually mean? So there is and the way for me to look at it is to kind of break down all the different parties involved and the financial impact to them. And then what does that actually mean, right? So first off, number one, always keep the investors, always keep shareholders first and foremost. Reducing the basis points, the expense ratio, from 20 to 18 bips is massive. Last I looked, it was over $285 billion trust fund. There's a fund. And do the math, 2 basis points on $285 billion is a massive transfer of wealth from the fund to the pockets of investors and shareholders. That's 2 basis points over time. It goes on forever into the future. So I think there's a huge financial incentive for investors and shareholders, current and future, of QQQ in order to do anything in their power to make this drop the total expense ratio. And as has been said, my entire career in financial services, which is too long to mention, basis points matter over time. That's number one. So let's look at Invesco. Invesco's financial position here, they're going to go from revenue of 0, not financial impact, but revenue of 0 to revenue of 18 basis points. Okay, so that would be a big change to Invesco, because they'll be able to recognize the 18 basis points on the fund revenue. And so that's a big change for them. Now, there's lots of things in there that make it make that a little bit different. People said to me, and there's an article a couple of years ago that talked about how Invesco doesn't make any money on the Qs. Well, that's not entirely true. There is a financial impact today, and there was at Nasdaq. The millions and millions of dollars thrown off by the marketing spend of the fund is of benefit to the sponsor. So, for example, the millions of dollars at Nasdaq that the QQQ spent on advertising naturally had a spillover benefit to Nasdaq. The millions of dollars that the Invesco QQQ spends has a spillover effect on Invesco. In both cases, those organizations did not need to spend that money. So although the Qs did not drive a direct revenue impact to Nasdaq or Invesco in this case, they did drive a huge bottom line impact by an offset of marketing expense. Now, there's a plus and a minus, and we'll get to that in a moment. I don't think Nasdaq has any change in the relationship. I think it's pretty clear Nasdaq gets a license fee, and Nasdaq will continue to get a license fee for the index. Now, the difference for the fund itself, the fund is going to receive 2 less basis points. The fund will, in my opinion, benefit from the trade-off there, because that the fund gets more freedom through the board that they pointed out and through the management by Invesco to do things a little bit more efficiently and effectively now than they did in the past. They have a little bit more discretion. So, for example, the UIT can't reinvest dividends. The QQQ, the open-end management fund, can. So the Qs have always carried a cash balance until distribution. There's some tracking error there. That changes. So there'll be better tracking. The Nasdaq 100, the QQQ, the UIT has to invest in the 100 stocks exactly in order, et cetera, et cetera. The open-end management does not. It can invest in maybe lesser numbers if they want to optimize the basket to get the same return, to get the better tracking error, to get a smaller tracking error. They'll be able to, UITs can't do securities lending. Open-end funds can. So there'll be a huge impact of reducing expenses and actually growing revenue to Invesco for securities lending. And these are stocks that are in high demand. Lastly, though, I think this goes to really a lot of the core of it, which is distribution. Pick this up very first day with the Qs. is distribution was, and always will be key to success of products in the marketplace. Right now, distribution is very focused on the marketing spend of the Qs, and then, trying to supplant that with other distribution mechanisms. The ability for Invesco to use the marketing of the Qs to better compensate the entire sales force, better integrate the QQQ marketing and branding with the Invesco marketing and branding, et cetera. All that is going to be a benefit. So I think you're going to see a different mix in distribution. I think you're going to see a much better mix in distribution tailored for the modern market today. So I think you're going to see that that's one of the reasons Invesco is doing this, is to be able to take advantage of the best way to continue to push this product forward in the marketplace, and so on. So again, shareholders get a huge benefit. Invesco gets some benefit. It's just a change in the way it is on their financial statements. Nasdaq remains the same. The fund, I think, is going to be more discretionary and more effective and efficient at what it does. So it's in my opinion, these are how the financial impacts line, and exactly why Invesco is doing this and why they're doing it now. So anyway, let me stop there and see if Viv, you want to weigh in.
Yeah, sure, John. So I thought, without kind of talking about why there was a UIT in the first place, if we end this conversation, we don't discuss that may leave some people hanging. And, you mentioned with the QQQ trying to get to market fast. Well, these early ETFs way before 6011, they needed exemptive relief from the staff. And when I was there in that office, if you think about the 80s and really the ingredients that led to the first ETF, it's kind of like human beings coming out of swamps and living on land. It all fed into the first ETF, because you don't realize, I think in the 80s was the first time you were able to use a computer and compute the value of the S&P 500 on a real-time basis. That led to basket trading. There were big insurance companies, portfolios, they wanted to invest with a diversified group of stocks, and it was more efficient to own a basket of the S&P 500. So you had basket trading going on. You had innovation kind of at the CFTC, where you had the first S&P 500 futures, which, opened up being able to hedge that portfolio. And if you think about how ETFs operate today, a critical part is the AP being able to hedge. And you also had arbitrageurs emerging that are arbitraging between the futures and the actual value of the S&P 500 component. So you had all that going on, and who kind of was involved in that mix was a firm called Leland, O'Brien, and Rubenstein. They also did portfolio insurance, which may have contributed to the 1987 crash, but we'll leave that story to the side. But they came in with a proposal because they were well versed in trading in baskets, and when they came in for exemptive relief in our office, and I wasn't working directly on it, but I knew what was going on. They came in with the UIT structure, and we don't have to really get into the weeds, but I think number one, the UIT structure, like John mentioned, worked perfectly for their product because essentially a UIT is a basket of securities, a fixed basket of securities. I think the other thing is, I mentioned that UITs they're governed by Section 26 of the 40 Act, but they're not subject to a lot of the other regulations that you would have needed exemptive relief from. So even though it was a first, and we had to go up to our division had to go up to the commissioners, There was going to be less exempted relief that needs to be done. And then third, there was a product called Americas, which was a UIT that was different. It was more single stock, but it had units that traded on an exchange. So there was a no action letter. So they had precedent. So they had all those going with going with the UIT structure versus an open-end fund structure. And really today, obviously QQQ works fine as UIT. So it worked out for them. John just went through the advantages of shifting to it. But I think it's important to answer that question, why was the first ETF a UIT versus an open-end fund. I don't, John, we could go through, let me just touch on kind of quickly some of the points you made. So if you look at the proxy, like all proxies, they're trying to convince the shareholders to vote for it. And it lists the advantages. And John went through the advantages, and he started with the fee decrease, which is probably the most important. The other thing I think the proxy points out was the ability to use custom baskets, and also the ability to deal with cash. And I was just going to kind of do a little back and forth, John. What do you think, is that going to help basically the QQQ track the Nasdaq 100 better? The ability to use custom baskets, the ability to get cash reinvested. How important is that?
I think it's very important. I think it's always been a challenge because, as we talked about earlier, Qs then typically do have a cash balance because they're getting dividends. And early on, the Nasdaq 100, totally different makeup. These companies were not paying dividends. Now today, there's a lot of dividend-paying stocks in the Nasdaq 100, so there's a tremendous cash balance. And then you're trying to post the basket every day, which is 100 stocks plus the cash. You have no ability to optimize that basket or do custom baskets, or not no ability, but it's very limited. I think today, or in the future, when the conversion is complete, the ability to do custom baskets, how you can handle cash, will allow much better and tighter tracking to the Nasdaq 100, which, by the way, is very tight today, but will allow, especially for certain periods of time. Every year in December, usually the third, if I remember correctly, the third Friday in December, the Qs, or the Nasdaq 100 index, is reconstituted, where they go through and they remove a couple of companies, add a couple of companies. Throughout the year, they have to remove companies that get merged or some other reason, and then they have to add a replacement company, etc. They have to constantly look at diversification tests to make sure that they're keeping up with the size of the company in relation to each other, and whether or not they changing the weights in the basket. So there are times that a custom basket is really helpful in order to not lag the fund tracking the index. So I think custom baskets and the new ability to handle the cash piece of this, plus securities lending, is really going to make the open-end fund QQQ a much tighter tracking mechanism or be able to track much tighter to the Nasdaq 100 index.
And one of the things talked about in the proxy too, as an advantage, and it's kind of an interesting topic, is having an external advisor. And you don't have that currently with QQQ or UITs. And what's interesting, we've talked about the flexibility, and that would be that external advisor implementing the things that John talked about, like securities lending. Those people in the building would be coming up with that. On the flip side, you now introduce this kind of human element. Obviously, businesses are in it for profit. And one of the beauties of a UIT is you really minimize the ability for somebody to take opportunistic kind of actions that for themselves, and then also hopefully it benefits the fund. You now have that when you go with an external advisor. And I'm talking about things like using an affiliated broker dealer, or, John mentioned some of the things they thought they needed to do to comply with the regulation M and make it better. But now you have more of ability, I guess what I'm saying, to change things, to change a product that's been phenomenally successful over these years. And we'll touch on it before we end. They don't have unilateral discretion to do these things. There is a board, and that's important check on it. But I think external advisor can cut both ways on the advantages.
I think you're absolutely right. I do think, though, that put it this way: if this were just going to a new, like when we launched it, or a small shop, that'd be one thing. Invesco has a long and successful track record in managing exchange traded funds and mutual funds and other products. They know exactly how to manage these things and how to be efficient and effective. I think that this will also dovetail into their current operation. So I do think that they do have, in fact, the experience and the knowledge, the expertise, and the connections to do that. The second thing you pointed on, which I do want to point out, I think is very important as a person who serves on a couple of ETF boards, is the board has ultimate responsibility, and the board does weigh in quite a bit. I looked at this proxy, and they're putting together a strong, vigorous, rigorous board, and that's exactly what you want. You want a board that is going to have the fiduciary responsibility. They're the ones looking after the investors, current and future. And so I think that is a great dynamic. I think it's a dynamic that Invesco is very familiar with, as most ETFs have that board. And as I said, from my personal experience, and I know, Bib, you see the same thing because you act as a counsel to many ETF boards. It is a really important process that didn't have to happen in the past because it was an autopilot kind of thing. But now it's going to be a managed product, and there's a board that sits at the top of that whole process.
Yeah, let's talk about the governance part, because I think that's one of the other key differences besides the fee decrease. So you look at a QQQ, any ETF, they really have three things that are kind of surrounding them. They have the shareholders, they have the board, and they have the advisor. And if you look at the proposals, they touch on all three. We have the modification of the agreement, which is really setting the rules between those kind of three parties. We have the external advisor, which I mentioned. So you're adding a third component to it. And then you're bringing in not a bank, replacing a bank with humans. And I think one of the things that's really interesting is that, like I said, now you're introducing different people that can impact the QQQ and its future. And the board has broad powers to do that. And so you don't have a bank that's just following along with the indenture and making sure it's complied with. Now you've opened it up to the advisor making recommendations to a board, and the board has the power to change things, including that governing agreement. And one of the things that's always kind of interesting in the corporate governance is the role of the shareholders. And in this case, when you look at the modifications to the trust indenture, they talk about what will be the powers of the shareholders going forward. And unlike operating companies, which are required to have annual shareholder meetings every year, which gives the opportunity for shareholders to have a voice or try to implement changes. The fund industry, typically under Delaware law, shareholders don't have that annual meeting. And in fact, if you look in this indenture, which is very similar to the trust instruments of other ETFs, shareholders have no right to call a shareholder meeting at all. The way I read it, they have the right to request proposals. So, what that means is that it's really a lot of responsibility is placed on the board. They've chosen to use independent trustees from their existing ETFs, and they're highly qualified, they're highly independent, and I think it's going to be a fascinating role for them to be able to keep the interests of the shareholders in mind when there are going to be potential changes to the QQQ ETF that this conversion will allow. And that's kind of the difference now, because now you don't really need a board because everything's locked in to an indenture. Going forward, if these three proposals are approved, you're going to need a board to guard the interests of the shareholders, because like this ETF and like others, they don't have a lot of power through their own ability to call shareholder meetings to influence things. So one of the last things I thought we would just discuss is, is this going to happen with any other ETFs that are organized as UITs? What's your thinking, John?
Well, first off, there's not a ton of them, but I think you pointed out to me in the past that, and we know because we studied it very clearly, spiders is kind of a unique situation. I think that would be a much more complicated process. I think any UIT is going to obviously look at it, and they're going to look with keen interest to see how Invesco proceeds and their success with this and everything else. So I think every UIT will look at it, but I don't know that it's going to open the floodgates for the few that are out there. So, so I don't know. I mean, I don't know. What are your thoughts on the same topic?
Yeah, I tend to agree. I'm sure if the business arrangements could and the business interests could be satisfied, Spider would look at it. I just got back yesterday from the first ICI ETF conference, which was a great conference, by the way. And what part of the big talk was innovation. There's a lot of talk, as you can imagine, about the mutual fund ETF share class. Good luck trying to do an exemptive application with the UIT for that. So assuming that gets ordered, that's an example of maybe something. I don't know if that would work with power shares that well, but there may be a reason to do that with the QQQ, and that will be presented to the board as, hey, here are things we think that can enhance the QQQ. So yeah, I mean, I think that's as the industry continues to modernize and innovate, it's a lot easier when there's regulatory hurdles you have to cross to be in the open-end structure versus the UIT structure. So I'm sure that the groups involved with Spider, as well as any other ETFs that are UITs out there, are considering that.
Yeah, I mean, I think you brought a great point. It's very much on a lot of minds, a lot of people's minds, is the multi-share class from an ETF on an open-end fund. One thing, since the day I launched QQQ, we knew that the 403, the 401k channel, the defined contribution channel was off limits to ETFs. They just didn't work well unless you had a brokerage account, which is really an expensive option, not very efficient. They're designed for mutual funds, open-ended mutual funds, and that's what works well on those. For the most part, there's obviously exceptions to that. But so there are lots of Nasdaq 100 index mutual funds out there. There are lots of those that exist, But the Qs itself has never been able to access that 401 defined contribution market. And it would be nice if it works out when these orders get approved and people can do multi-share class, and if they figure out the operational issues in the industry, there's a possibility that you could see a share class out of a QQQ or other products like this that create mutual funds that fund share classes that will work in defined contribution plans. So more to come on that, but it's a lot. I think there's a lot better path forward as an open-end fund than there would be as a UIT for this particular thing.
Well, great. So I know John and I will be watching this vote, and again, best of luck to Invesco in securing it.
Absolutely. Bib, I can't see questions. Do we have any questions on the chat right now? Or I think we covered, I try to incorporate just questions in the topics we covered, but.
Yeah, I think we covered it.
Okay.
You can always give one of us a call. You can
Sure.
find us at ETF BILD. We're always love to chat about these topics. So.
Absolutely. QQQ is one of my favorite topics, as you can imagine. So anyway, well, good luck to Invesco. And I think we're wrapping it up right now. So thank you.
Thanks.